Have you ever wondered what an ETF is and how it can benefit your investment portfolio? ETF stands for Exchange Traded Fund. It's an investment fund that, much like stocks, trades on major stock exchanges. Here's an easy way to think about it. ETFs are like a basket, but instead of apples or oranges, this basket contains a range of different investments, such as stocks, bonds, or commodities. Think of ETFs as a middle ground between mutual funds and individual stocks. Much like mutual funds, they offer a way to invest in a diversified portfolio. But like individual stocks, they can be bought and sold throughout the trading day at fluctuating prices. This unique blend of characteristics makes ETFs an intriguing option for many investors, from the novice dipping their feet in the investment pool to the seasoned trader looking for diversification. Let's delve a bit deeper to understand how ETFs work and their structure. The workings of an ETF might seem complex, but once you grasp the basics, it's a straightforward concept. To start, let's imagine an ETF as a basket. This basket holds a variety of different assets, such as stocks, bonds, or commodities. The contents of the basket represent the ETF's structure. Now, this basket doesn't just materialize out of thin air, it's created and redeemed by entities known as authorized participants, or APs for short. These APs are typically large financial institutions that have a direct relationship with the ETF provider. Here's how it works. An AP assembles the basket of assets that the ETF wants to hold. They then deliver this basket to the ETF provider in exchange for shares of the ETF. This process is known as creation. Conversely, when an AP wants to redeem ETF shares, they return them to the ETF provider and receive the basket of assets in return. This is known as redemption. This constant process of creation and redemption carried out by the APs is crucial because it helps maintain the liquidity of the ETF and ensures that the price of the ETF shares stays close to the net asset value of the assets in the basket. So that's the basic structure of an ETF, but not all ETFs are created equal. There are different types of ETFs designed to cater to a variety of investment strategies. For example, there are index ETFs that aim to replicate the performance of a specific index. If you're interested in a particular sector like technology or healthcare, there are sector ETFs. Commodity ETFs allow you to invest in physical commodities like gold or oil. And then there are bond ETFs that invest in bonds and other debt securities. Understanding the different types of ETFs and their structure is key to knowing where they fit in your investment strategy. They offer diversity, flexibility, and accessibility, making them a popular choice for many investors. Now that you have an understanding of what an ETF is and how it works, it's time to learn about the key points of ETFs. ETFs are versatile tools in the financial market. But what makes them so appealing? For starters, ETFs are traded like stocks. This means they can be bought and sold throughout the trading day at fluctuating prices, giving investors the flexibility to react to market changes. Another key point is the diversification benefits. An ETF often holds assets across various sectors, reducing the risk of a single company's performance impacting your investment. Transparency is another attractive feature. ETFs disclose their holdings and daily net asset value, allowing investors to know precisely what assets they own and their current value. Tax efficiency is another advantage. ETFs offer potential tax advantages due to the in-kind creation and redemption process, which can help limit the capital gains distributions that investors might have to report. While ETFs offer numerous advantages, it's also important to be aware of their drawbacks. Like any investment, ETFs come with their own set of advantages and disadvantages. Let's start with the brighter side, the advantages. ETFs are like a basket of multiple securities, providing instant diversification. Instead of picking individual stocks or bonds, you're buying a slice of the entire market. This can help to spread risk and potentially smooth out the bumps in your investment journey. Another major advantage is their liquidity. ETFs trade like stocks, meaning they can be bought and sold throughout the trading day at market prices. This is in stark contrast to mutual funds, which only trade at the end of the day at a set price. This flexibility can be a real boon for active traders. Now let's talk about costs. Generally, ETFs tend to have lower expense ratios compared to mutual funds. This is largely because most ETFs are passively managed, tracking a specific index rather than trying to beat the market. Over time, these lower costs can make a significant difference to your returns. Transparency is another key advantage of ETFs. They disclose their holdings on a daily basis, allowing you to see exactly what assets you own. This level of transparency is quite rare in the investment world. However, no investment is without its drawbacks, and ETFs are no exception. Trading costs can be one such disadvantage. While the expense ratios may be lower, frequent trading of ETFs can rack up brokerage fees, which could eat into your returns. Another potential downside is the tracking error. This is when the ETF doesn't perfectly mimic the performance of the index it's tracking. It's usually minimal, but it's something to keep an eye on. Also, the price of an ETF can sometimes deviate from its net asset value or NAV. This means you might end up buying or selling shares for more or less than their actual worth. Lastly, while diversification is an advantage, it also means you have less control over your portfolio holdings. You're stuck with the securities in the ETF, whether you like them or not. As with any investment decision, it's crucial to weigh these advantages and disadvantages to determine if ETFs are the right fit for your portfolio.